All right, let's dive right in. We're tackling a cornerstone of investing today, U.S. blue chip stocks.
A classic topic, definitely.
Yeah, and for decades, the common wisdom has painted them as these safe, stable bedrock investments, like the reliable anchors you need, especially when the market gets choppy.
That's the traditional view, absolutely. The safe harbor.
But in today's fast-moving world, there's this strong counterargument that, well, it emerges from the sources we've gathered today. Are these giants simply slow, maybe even, dare I say it, boring choices that just can't keep pace?
That's the big question, isn't it? Stability versus speed.
Exactly. So the question for you listening is, are these giants the reliable anchors you really need for your financial future? Or are they just, slow-moving turtles in the race for returns?
That tension, that push and pull between the stability, the reliability, and the potential for maybe faster, more explosive growth elsewhere. That's absolutely central to understanding this whole category of stocks. It's where a lot of the investor debate really happens.
And to really dig into this, we've pulled together a mix of perspectives. We've got articles from, established financial sites, The Motley Fool, Grow, Simply Wall Street, Alpha Spread, offering professional analysis, data, that sort of thing.
The analytical side, yeah.
And then to get a feel for the real-world investor sentiment, how people are actually talking about this stuff, we've dipped into a pretty lively discussion thread from Reddit.
Oh, that blend is crucial, I think. The formal analysis gives us the data, the frameworks, the sort of academic view. But the Reddit thread, that provides that ground-level perspective. How are everyday investors actually thinking about these massive companies? What are their perceived strengths? What are their frustrations? It adds a whole layer of practicality.
Absolutely. Couldn't agree more. So our mission today is pretty clear. We're going to unpack this stack of sources. We want to define what truly makes a stock a blue chip, weigh their significant pros against the cons.
The good and the bad.
Right. And look specifically at titans like Johnson & Johnson and Procter Gamble through the lens of this very debate and explore the different ways investors view them. Ultimately, we want to give you the information you need to figure out if and how these giants of industry fit into your investment strategy and your goals.
Sounds like a plan. So where should we start? Maybe with the name itself. Blue chip. It sounds a bit like, a casino term.
It does. It really does. Tell us more about that origin. I find that fascinating.
It's actually exactly where it comes from.
Mm-hmm.
The term originates from poker. In many traditional poker sets, the blue-colored chips represent the highest value chips in the game, the most valuable ones on the table.
Ah, okay, so the high rollers.
Precisely.
Yeah.
So when the term was adopted for the stock market, it was a direct analogy. It refers to the stocks of companies that are considered the highest value, the most reputable, and the most financially stable in the market. It's really about signifying top quality, trustworthiness, the best of the best, supposedly.
So it's the financial market's way of saying these are the big leagues.
Got it. Beyond that origin story, though, what are the fundamental characteristics? What do multiple sources agree really defines a blue chip stock? What puts a company in that elite category?
Well, several key traits consistently pop up across sources like the Motley Fool, Grow, CapTrader. First and foremost, they're stocks of well-known, high-quality companies. Think household names, companies that have been around for a long, long time.
Familiar brands.
Exactly. And they are almost always industry leaders, not just players in their field, but leaders with dependable business models that have proven themselves resilient over time through different economic cycles.
So not just popular, but dominant in their space. That leadership aspect is key.
Precisely. Dominant. They have a strong reputation, and that's not just with consumers buying their products, but also critically with shareholders who trust their management, their track record, their performance. The Motley Fool really emphasizes that they've stood the test of time, weathering various economic cycles and market shifts. That history, that endurance, that feels critical to the whole definition, doesn't it?
It absolutely is. It's fundamental. And a defining feature for many, many investors, mentioned by Motley Fool, Grow, and CapTrader, is that they typically pay regular and consistently growing dividends.
Ah, the dividends. Always comes back to the dividends with blue chips.
It often does, because this provides a reliable income stream, which is a major draw for certain types of investment strategies, obviously.
Yeah, those dividend aristocrats or dividend kings often come to mind here.
Indeed, we'll likely touch on those terms again. And finally, they're characterized by a large market capitalization. Now, market cap isn't the only factor, as CapTrader rightly points out, but blue chips are inevitably massive companies by valuation. Grow and CapTrader both list this as a key identifier.
Okay, so summing that up, Big, stable, reputable industry leader, pays growing dividends, and has endured. That seems to be the core definition we're working with. But how do you move from that general description to actually identifying a specific blue chip company? CapTrader says it's not automatic just based on size.
That's a really important distinction they make. While size is, a necessary condition, it's definitely not sufficient on its own. CapTrader outlines some specific criteria used for identification. One is undeniable financial strength.
Okay, what does that entail?
Well, it includes large market cap, yes, but they say you also have to examine their debt ratio. That's basically how much debt a company carries relative to its assets or its equity. A blue chip should ideally have a manageable debt load. You don't want them drowning in debt.
Right, so they're not over-leveraged, they have breathing room.
Exactly. Breathing room is a good way to put it. Stability of cash flow is another crucial financial metric they highlight. Can the company reliably generate cash year after year consistently, even in tougher economic times? This speaks directly to their operational resilience, their ability to keep the engine running.
Because cash flow is the lifeblood of any business, big or small.
It truly is. Now, beyond the balance sheet, CapTrader heavily weighs the consistency of dividend payments. We talked about paying dividends, but increasing them annually, year after year, for a significant period that's seen as a really strong indicator of financial health and management's confidence in the future.
Like a public statement of confidence each year.
In a way, yes. And CapTrader specifically calls out Johnson & Johnson, J&J, for its history of increasing its dividend annually for over 50 years. That's just a remarkable sign of consistency.
Over half a century of payout increases. That's truly standing the test of time right there. Wow.
It absolutely is a testament to their model. Now, third factor CapTrader identifies is a strong market position and business model. Are they genuine leaders? Do they possess clear competitive advantages? Things like strong brands that everyone recognizes, patents that protect their innovations, maybe unique distribution networks.
The moat we hear about sometimes.
We'll definitely get into the moat concept more. Yes, it's related. And do they have experienced management teams? People with a clear, well-executed strategic direction. Leadership quality really matters, even for these giants. It's not just about the existing structure.
So it's not just the business itself, but who is actually steering the ship day to day, year to year.
Right,
Yeah.
Exactly. And finally, CapTrader reminds us to look at the external environment too. While blue chips are known for being resilient, they aren't completely immune to competitive pressure or, importantly, changes in the regulatory framework they operate within.
Regulations. That can trip up anyone.
Absolutely. A sudden disruptive technology could emerge, or a new government regulation could pose a significant challenge even to a dominant player. So identifying a blue chip involves assessing its ability to navigate these external forces effectively.
Okay, so it's a really comprehensive look. Internal strength, external resilience, management, finances, the whole picture. Speaking of identifying them, is there an official registry or a definitive list somewhere? The Motley Fool FAQ says no single official list exists.
And that's correct. There isn't, a formal government body or a single stock index that exclusively defines the blue chips. However, you will overwhelmingly find blue chip stocks represented in the major market indexes.
Like the S&P 500.
Exactly. The S&P 500, which tracks 500 of the largest U.S. companies, contains many of them. The NASDAQ 100, which focuses on the largest non-financial companies listed on the NASDAQ exchange, includes others, especially those big tech blue chips we all know.
But there's one index that's almost synonymous with blue chips, isn't there? Kind of the classic one.
Absolutely. You're thinking of the Dow Jones Industrial Average, the DJIA. CapTrader and the Motley Fool FAQ point specifically to it. While maybe not every single stock in the S&P 500 or NASDAQ 100 might meet the strictest blue chip definition in everyone's book, CapTrader makes the assertion that all 30 stocks currently included in the DJIA are typically considered blue chips.
So the Dow list is pretty much the go-to list for U.S. blue chips, effectively.
It's certainly the most concentrated, well-known collection. CapTrader actually provides that list of 30 companies in their material. And beyond our specific examples of J&J and PG that we'll discuss later, it's just a roster of American corporate heavyweights.
Give us a few more examples from that list.
Sure. You see names like Apple, the tech giant, Microsoft, dominant in software and cloud computing, Coca-Cola, the iconic beverage company, Home Depot, the massive home improvement retailer, McDonald's, the global fast food kingpin, Chevron, a major player in energy, Goldman Sachs in finance, IBM, a long-standing tech firm, Intel in semiconductors, Nike in sportswear, Walmart, the retail behemoth, Walt Disney and entertainment. I mean, these are companies that are deeply, deeply embedded in the global economy and everyday consumer life.
That scale is just staggering when you list them out like that. And the Motley Fool FAQ notes something interesting, that the U.S. is home to more blue-chip companies than any other country.
Yeah, that's likely a reflection of the sheer size, the maturity, and the historical global dominance of the American economy and its largest corporations over the past century or so.
Okay, so we've defined them, we've talked about how to identify them, the Dow list as a key reference point. Now let's shift gears. Let's talk about why investors are drawn to them in the first place. This is the core of that reliable argument, right? What makes them so appealing to so many people?
The paramount reason, the one that comes up again and again, is their perceived stability and reliability. The Motley Fool explicitly calls them safe investment opportunities. Grow and Motley Fool both highlight their dependable business models.
Okay, but what does dependable business model mean in practice?
Well, as emphasized by CapTrader and Grow, it means their solid financial basis and their established market positions help them withstand economic downturns and market crises much better than smaller, less established companies typically can.
So the idea is, when the market gets rough, these are the companies that might offer a steadier ride, less volatility.
That's precisely the idea. CapTrader points out they are generally less susceptible to those wild, volatile market fluctuations. During periods of uncertainty, investors often talk about a flight to quality, and blue chips represent that perceived quality and resilience. Think of them as the sturdy ships that are less tossed about by the big market waves.
That stability is definitely a powerful draw, especially for certain types of investors. And then there's the dividend component, which seems absolutely central to their appeal for many.
Oh, absolutely central. Motley Fool, Grow, CapTrader, they consistently mention stable, regular, and crucially, growing dividends. It's not just about getting a payment. It's about getting a payment that tends to increase year after year predictably.
So a reliable income.
Yes, CapTrader notes this provides a reliable source of income. That's attractive whether you're, say, a retiree living off investments or maybe someone younger just seeking to supplement their income.
And the power of compound interest comes into play with those dividends too, doesn't it?
Exactly. CapTrader explicitly mentions taking advantage of compound interest by reinvesting those growing dividends. You buy more shares with the payout, then those new shares start earning dividends themselves, and the whole cycle starts to accelerate your asset building over the long term. It's a powerful wealth-building mechanism if you have time.
Yeah, compounding is magic.
It really can be. Motley Fool also brings up that category of dividend kings. These are companies that have increased their dividends for 50 years or more consecutively. They note that blue chips frequently belong to this very elite group. This isn't just a short-term trend. We're talking decades of commitment to returning value to shareholders through increasing cash payouts.
Wow. That level of consistency is incredibly hard to find anywhere else in the market, I'd imagine.
It certainly is. And while we'll look at J&J and PG specifically later, CapTrader notes, just as an example, that as of August 2024, Verizon was the DJIA component with the highest dividend yield at 6.81%. So that shows that some blue chips can offer substantial income streams right now, not just the promise of future growth in the payout.
So it's a key part of the overall value proposition, especially for income-focused investors. Okay. Moving beyond income and stability, you also mentioned blue chips are valued for portfolio diversification. How does investing in these huge, well-known companies actually help with diversification? Isn't it better to have lots of different types of companies?
Well, yes, diversification across asset classes and company types is important. But blue chips contribute in a couple of ways. Firstly, as Motley Fool states, just their inherent stability during turbulent conditions offers a form of diversification against volatility itself. They might hold up better when other parts of your portfolio are struggling.
Okay, so smoothing the ride.
Smoothing the ride, exactly. But CapTrader adds another layer. Because many blue chips are massive multinational corporations operating globally across various sectors, think about a consumer goods company like P&G selling everywhere, or a tech company like Microsoft with diverse product lines and global reach investing in them, inherently diversifies your exposure across different geographic markets and different industries, all within a single stock sometimes.
Ah, I see. So buying one blue chip stock can actually give you exposure to multiple economies and consumer bases around the world.
Right. Grow points out this global diversification helps cushion the impact of negative events like a recession or high inflation or economic stagnation if it happens in just one single country or one sector. CapTrader sums it up nicely. It reduces the risk associated with concentrating your investments too heavily in just one specific area.
That global reach is definitely a significant advantage. Okay, and finally, the long-term potential. Are they suitable for growth over decades? I mean, they're already huge.
That's the common question. Grow suggests they are suitable for long-term financial goals, often recommending an investment horizon of 7 years or more. CapTrader views them as offering a reliable opportunity to build assets continuously over many years. Now, you might wonder, how does a massive mature company continue to grow significantly?
Yeah, where does the growth come from?
Well, CapTrader suggests these companies continuously invest heavily in things like expansion, research, and development, R&D. They adapt, they innovate, sometimes they acquire smaller, faster-growing companies. This constant investment enables them to find pockets of growth even in markets that might seem saturated on the surface.
So it's maybe not explosive growth, but perhaps steady compounding growth over the long haul.
Exactly. That's generally the expectation. And this is where Alpha Spread's analysis, introducing the concept of the economic moat, becomes incredibly insightful. You mentioned it earlier.
Right, the Warren Buffett idea.
Exactly. Popularized by Buffett. Think of the moat as like the protective barrier around a medieval castle, keeping attackers out. In business, an economic moat represents a company's durable competitive advantage, the structural features that protect its profits and its market share from competitors over the long term.
So it's something that makes it really, really hard for a new company or even an existing rival to come in and steal their business or undercut their prices.
Precisely. It's that defensibility. And Alpha Spread's research into this concept is actually quite striking. They analyzed performance and found that companies they identified as having a wide economic moat, meaning a very strong, very long-lasting competitive advantage, significantly outperformed the broader S&P 500 index over a 10-year period they studied.
Significantly outperformed. How much are we talking?
Their data showed the wide moat stocks delivered a total return of plus 645% over that decade, compared to the S&P 500's return of plus 188%.
Wow. 645% versus 188%. That is a massive difference. That strongly suggests that having a powerful competitive moat isn't just about stability and defense, but it can actually lead to superior long-term investment performance, too.
It really underscores the power of that sustained competitive edge. It's not just about surviving, it's about thriving long-term. Alpha Spread identifies 5 key drivers, 5 sources that create these economic moats.
Okay, what are they?
First, the network effect. This is where a product or service becomes more valuable as more people use it. Think social media platforms or credit card networks or online marketplaces. The more users, the stronger the pull for new users.
Right, like Facebook or Visa.
Exactly. Second, switching costs. This refers to the time, the effort, or the money it takes for a customer to switch from one product or service to another. Think about changing banks or migrating complex enterprise software systems. If it's a huge hassle, customers tend to stick around.
Yeah, nobody likes switching banks.
Tell me about it. Third, intangible assets. These are things like incredibly strong brands, think Coca-Cola, Apple, Nike, or patents that protect drugs or technologies, or valuable regulatory licenses that are hard to obtain.
Things you can't easily copy.
Right. Fourth, efficient scale. This applies where a market is most efficiently served by just one or maybe a very few large players. Adding another competitor would actually decrease returns for everyone involved because the market can only support so many. Think local utilities or specialized infrastructure like pipelines or airports.
Natural monopolies, almost.
Kinda, yeah. And fifth, cost advantage. This is the ability to produce goods or services at a consistently lower cost than competitors. This allows a company to either offer lower prices to gain market share or maintain higher profit margins. Think Walmart's legendary supply chain efficiency.
Okay, so network effect, switching costs, intangible assets, efficient scale, and cost advantage. A blue chip often has one or more of these advantages deeply embedded in its business.
That's the core idea, yes. These moats protect their pricing power, they protect their market share, allowing for that sustained, profitable growth over decades. It's a really powerful framework for understanding the enduring success and potentially the outperformance of many blue-chip companies like Alpha Spread's data suggests.
All right, that makes a really compelling case for blue chips as reliable cornerstones. They offer stability, income, diversification, and maybe even superior long-term returns if they possess these strong economic moats. But, and there's always a but, as we posed right at the start, are they simply slow growers? Let's look at the counter-argument now.
Okay, this is where the narrative shifts. From robust giants to perhaps ponderous elephants, right? Grown explicitly lists a slow growth rate as the potential disadvantage of investing in blue-chip stocks. They state pretty clearly that these companies generally experience a lower growth rate compared to, say, smaller, faster-growing companies in more dynamic emerging sectors.
So if you're looking for a stock that might double or triple in value in just a year or two, maybe aiming for those huge quick gains, a blue chip probably isn't your best bet.
Likely not, no. Grow notes, they may require patience for significant returns, specifically from price appreciation alone, separate from dividends. There's a common perception, which Grow also mentions, that these large, mature companies have perhaps already reached their maximum growth potential. Their biggest expansion phases might be behind them.
They've already conquered their main markets, essentially. There's less room to grow dramatically.
To a large extent, that's the argument. Another potential drawback that Grow highlights is, interestingly, lower dividend yields.
Yeah.
Now, wait, you might say, didn't we just talk about growing dividends?
Yeah, I thought they were dividend machines.
They often are, in terms of growth of the dollar amount.
Yeah.
But the yield itself, which is the annual dividend payment calculated as a percentage of the current stock price, might actually be relatively low compared to certain other income-focused investments. This can happen especially if the stock price itself has risen significantly over time.
Okay. So you might get a bigger dividend check each year in absolute terms, but the percentage return on your initial investment, or based on the current high price, might not be as high as, say, a high-yield bond fund, or maybe some utility stocks that traditionally pay out a larger portion of their earnings as dividends.
Exactly that. The dollar amount of the dividend might increase nicely each year, but the yield percentage could still be quite modest compared to alternatives, particularly if the stock is trading at a high valuation multiple.
And speaking of valuation, Grow points out that blue chips can sometimes be comparatively expensive.
Yes, their very desirability. Because of the high demand, the perceived reliability, the low-risk profile, the lower volatility, means investors are often willing to pay a premium price for them. They command a higher price tag in the market.
So they might trade at higher multiples, like a higher price-to-earnings ratio or price-to-book ratio, compared to less stable or less proven companies.
Precisely. They often do. And this ties directly into a warning that CapTrader gives about the risk of overvaluation. This is a really important point. Even a fundamentally sound, high-quality blue-chip company can turn out to be a poor investment if you simply pay too much for its stock up front.
Right, buying at the peak.
Exactly. Overvalued shares are much more susceptible to price corrections, pullbacks, which can significantly mute or even completely eliminate your returns for a long time, even if the company's underlying business performance remains perfectly good.
So that perceived safety and reliability can sometimes come with a price tag that actually limits your future appreciation potential and even introduces this different kind of risk, the risk of a valuation-driven pullback.
That's the absolute core of the slow grower or potentially overvalued critique. You might be paying a significant premium for that stability and predictability.
Okay, this is getting really interesting. Let's try to bring this all to life now by looking at two specific, often cited blue chip examples. Johnson & Johnson, J&J, and Procter Gamble, PG. How do these real-world companies embody the characteristics and maybe also the tensions we've been discussing?
Great idea. Let's start with Johnson & Johnson, ticker J&J. Alpha Spread provides a good overview. Founded way, way back in 1886, so it's a true healthcare giant with an incredibly long history. Traditionally, as most people know it, it had a highly diversified business model. It spanned pharmaceuticals, medical devices, and those well-known consumer health products.
Right, the Band-Aids, the baby shampoo, the Tylenol, those famous consumer brands that are in everyone's medicine cabinet.
Exactly. That consumer segment was iconic, instantly recognizable. But the Motley Fool highlights a really significant recent change here. That entire consumer health business was spun off into a new, separate company called Kenvue, ticker KVUE, back in May 2023. Now, while J&J initially retained a large stake, Kenvue is now its own independent, publicly traded entity.
Okay, so the J&J that exists today is actually quite different from the J&J of, say, 5 years ago. It's more focused now on the higher-margin healthcare segments.
That's precisely the strategic shift they made. Motley Fool notes that post-spinoff, J&J is primarily focused on its pharmaceuticals and medical devices segments. And these are generally seen by analysts as having stronger long-term growth outlooks compared to the slower-growing consumer division.
Tell us a bit more about those two remaining segments.
Sure. Alpha Spread details them. The medical devices segment produces things crucial for surgeries, orthopedics, vision care products, deeply integrated into modern healthcare systems, often premium price, high-tech stuff. Then the pharmaceutical business is just vast. It includes blockbuster drugs many have heard of, like Remicade, Zytiga, Stelara. It's driven by massive R&D investment trying to find the next big thing, and these therapies tend to have very high margins, generating substantial revenue for the company.
So the thinking behind the spinoff was that this more focused J&J could potentially be less of a slow grower than the historical, more diversified entity was, shedding the slower part to accelerate.
That was certainly part of the rationale presented for the spinoff, yes, to potentially unlock better growth by concentrating resources on those higher growth, higher margin areas. Now, despite this potential focus and J&J's legendary stability and dividend history again, CapTrader points to over 50 years of consecutive dividend increases, making them a dividend king. Alpha spread provides an interesting counterpoint regarding recent performance.
Oh, how has it done lately?
Well, over the past 12 months specifically that Alpha spread looked at, J&J's stock actually underperformed the broader S&P 500 index. It returned about 7% compared to the S&P 500's approximate 12% return over the same period.
Ah, okay. So that's a concrete example right there, illustrating that slower growth relative to the broader market dynamic we discussed earlier. Even a healthcare giant, even after refocusing on supposedly higher growth segments, can still trail the overall market index.
It really shows that stability and a great dividend track record don't automatically guarantee market-beating price appreciation, especially in the shorter term. And the Reddit thread we looked at adds some really important real-world color to J&J's current situation.
What are everyday investors saying?
Multiple users on that Reddit thread specifically mentioned J&J's ongoing high-profile talc lawsuits as a major overhang, a dark cloud they believe is holding the stock price back significantly. One user flatly stated that they think J&J won't go anywhere until the litigation is resolved.
Wow. So a major legal challenge, a company-specific risk like CapTrader warned about, is actively impacting investor perception and potentially the stock's performance right now.
Exactly. The Reddit perspective really reinforces that slow grower label for J&J, at least currently in the eyes of some investors. Users feel it needs some kind of significant catalyst, or perhaps more realistically, the removal of this massive legal cloud before they expect to see substantial price movement. This just highlights that even for the most established blue chips, company-specific issues and external factors like regulatory or legal risks are very real and can significantly affect investment outcomes.
That's a very sobering point about J&J. Okay, let's move on to the other example. Procter Gamble PG, another absolute icon, this time in consumer goods.
P&G, yeah, a multinational giant selling products spanning health, beauty, household sectors. I mean, from Tide detergent and Pampers diapers to Gillette razors and Crest toothpaste, just ubiquitous brands. CapTrader lists them as a classic blue chip example, right alongside Coca-Cola in their discussion.
Products people buy almost automatically every day, pretty much regardless of the economy, right? That defensive quality.
That's a key aspect of their resilience, absolutely. And the Reddit thread captured this feeling perfectly. One user described PG as rock solid and then added, boringly steady, steady, steady.
Boringly steady, steady, steady. I like that.
You too? And it wasn't necessarily meant as a criticism in context. It was more an acknowledgement of its incredible stability and resilience, its ability to perform consistently through various economic climates. CapTrader highlights their continuous innovation and adaptation to changing consumer habits over decades, noting they've earned a permanent place in the portfolios of many investors.
A real buy-and-hold staple for stability and income, it sounds like. And like J&J, PG is also a very well-known dividend king, right? With a very long tradition of increasing its dividend payments year after year.
Yes, another prime example. It's a testament to their financial discipline and their stable cash-generating business model. But when we look at the growth side of the equation for P&G, Simply Wilson provides some forecasts that definitely align more with that slow grower perception.
Okay, what do the numbers suggest?
They forecast P&G's earnings growth at around 5.4% per year going forward, and their revenue growth is forecast even slower at about 3.3% per year. They expect earnings per share, or EPS, which is a key measure of profitability per share, to grow by approximately 5.5% per year.
3 to 5% growth. How do those numbers stack up against forecasts for the broader U.S. market?
Simply Wilson gives us that context, which is helpful. Their forecast earnings growth for PG, that 5.4%, is significantly below the average forecast they have for the overall U.S. market, which is running around 14.5% per year. Similarly, their forecast revenue growth for PG, 3.3%, is well below the U.S. market average forecast of about 8.7% per year.
Okay, so it's definitely positive growth expected, but clearly at a much, much, much slower pace than the average U.S. company is expected to achieve in the coming years.
Exactly. Simply Wilson defines high growth as being above 20% per year, so P&G's forecasts place it squarely in the moderate or arguably slow growth category relative to the overall market potential. However, there's another side to the P&G coin. Simply Wilson also forecasts something very positive about P&G's profitability.
Oh.
What's that? Their return on equity, or ROE, which measures how efficiently a company uses the money invested by shareholders, the equity to generate profits, is forecast to be very high, around 34.6% in 3 years' time.
34% ROE. That's impressive. So while they might not be growing the top line, their sales super rapidly, they are exceptionally good at turning what they do sell into actual profit for their shareholders. That speaks to incredible efficiency and strong pricing power, strong margins.
It absolutely does. It shows a highly profitable, extremely well-managed business, even operating at such a massive global scale. And simply, Wilson's own analyst view headlines, which they aggregate, capture this internal debate about P&G really nicely.
What kind of headlines do you see?
You see a mix. You get headlines like, "Hold this stodgy stalwart," which acknowledges the stability but clearly implies a lack of excitement, right? Or another one, "Unwilling to pay 24x earnings given the lack of growth," which directly highlights that valuation concern relative to the slower growth pace. But simultaneously, you see very positive headlines emphasizing the financial health and the efficiency. Things like, "Has a pretty healthy balance sheet, achieving high returns on its capital and consistent growth over time."
Wow, that perfectly encapsulates the whole blue chip balance or dilemma, doesn't it? Financially sound, highly profitable, consistently performing, but maybe not the high-octane growth story that some investors are really looking for. And that Reddit comment calling PG rock solid, boringly steady, 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 it just echoes this sentiment perfectly. Stability is prized, maybe even admired, but excitement isn't really the name of the game here.
It's the classic trade-off in action right there in one company.
Absolutely. Okay, so having explored the characteristics, the arguments for reliability, the counter-arguments about slow growth, and looked closely at J&J and PG as case studies, how do blue chips actually fit into a broader investment portfolio? It's not usually just about buying one stock, right? It's about building a whole strategy.
Right. Portfolio construction is key. Motley Fool suggests that blue chips can actually be a smart choice for investors of basically all types, across the spectrum. For beginners, they argue, the familiarity with the products and services, using Tide or owning an iPhone, makes them a comfortable starting point in the sometimes intimidating stock market.
Less intimidating than some obscure tech company, maybe.
Perhaps, yeah. And for experienced investors, their stability and proven ability to outlast rivals are highly valued, especially if the goal includes capital preservation alongside growth.
So they can provide that solid foundation for a portfolio. CapTrader actually calls them the backbone of a portfolio, suggesting they can form the core upon which other, maybe riskier investments are built.
Yes, exactly. The core or the backbone. And Motley Fool makes another key point that's directly relevant to portfolio allocation and goals. The more you prioritize preserving and protecting your invested money, maybe because you're nearing retirement or have lower risk tolerance, the more attractive blue chip stocks generally become. If your primary goal is capital preservation with some reliable income and moderate growth, they are often highly suitable.
Okay, but what if your goal is really maximizing growth? Especially if you're, say, a younger investor with decades until retirement. How do blue chips compare to other options specifically geared towards growth?
Yeah, that's the crucial comparison. And that brings us to looking at them side by side with growth stocks. CapTrader clearly contrasts blue chips with growth stocks. Growth stocks, they explain, are typically issued by smaller, often less established companies that are operating in new or rapidly expanding markets. These are the potential disruptors, the potential future giants.
So the established giants versus the aspiring giants. Is that a fair way to think about it?
I think that's a pretty fair analogy, yes. CapTrader highlights the key differences investors need to understand. First, volatility. Growth stocks are generally much more volatile. They react more strongly, both up and down, to market sentiment and news events. Blue chips, as we said, tend to be less volatile.
Okay, so bigger swings with growth stocks.
Typically, yes. Second, return potential. Growth stocks offer the potential for above average, sometimes even explosive returns. But that potential comes with significantly higher risk of loss. Blue chips, on the other hand, offer more reliable, perhaps more predictable, continuous asset building over many years.
Slower and steadier versus faster and riskier.
That's the general trade-off. And third, dividends. Blue chips, as we've discussed, usually pay regular, stable, and often increasing dividends. Growth stocks, however, rarely pay dividends. They typically choose to reinvest essentially all their profits back into the business to fuel and accelerate their own growth as fast as possible.
Right. They need the capital for expansion, not for payout. So it's a really clear picture of a risk-reward spectrum, isn't it? High risk, potential high reward with growth stocks, lower perceived risk, more moderate but hopefully steadier reward with blue chips.
Exactly. It's about understanding where you want to be on that spectrum, or how you want to combine elements from different points on it. CapTrader argues that blue chips provide that stability and income component, while growth stocks offer the higher return potential. The strategy isn't necessarily choosing one over the other exclusively, but rather deciding how to balance them effectively within your portfolio.
Finding the right mix for your goals.
Precisely. A balanced mix, they suggest, can effectively spread risk across different types of companies and market segments while still capturing different kinds of return opportunities to maximize your long-term gains according to your own profile.
Okay. And what about for investors who prefer a more hands-off approach? Maybe they don't have the time or, frankly, the desire to research individual companies like J&J or PG in detail.
That's a very common situation. For those investors, Motley Fool and Grow both recommend considering ETFs, exchange-traded funds, or mutual funds that are specifically focused on blue-chip stocks, or even broader market index funds, like those tracking the S&P 500 or the DJIA, which are naturally heavily weighted towards blue chips anyway.
So buying the basket instead of picking individual fruits.
Exactly. It's a simple, usually cost-effective way to gain exposure and instant diversification across many blue chip companies all at once without having to go through the process of picking individual winners or trying to avoid the losers.
So you get the general blue chip exposure and the diversification benefits automatically with much less effort.
Right. Motley Fool notes these types of funds are generally less volatile than holding just a few individual stocks, which makes them appealing for folks nearing or already in retirement, or perhaps for younger investors who simply want broad diversification without the intensive research time required for individual stock picking. Grow also briefly mentions other potentially less volatile investment options for very conservative investors, like real estate, fixed deposits, similar to certificates of deposit or CDs, or government bonds. But they frame these more as alternatives depending on your specific risk tolerance and income needs, obviously. These are entirely different asset classes from stocks.
Understood. Okay, so blue chips, whether held individually or maybe more commonly via funds, clearly have a role, particularly for adding stability, income, and forming that portfolio backbone. And they can complement higher growth investments well. But let's loop back to that important point CapTrader made earlier. They are not a safe haven. Let's dig a bit deeper into the risks. What can still go wrong even with these massive established giants?
Yeah, that's a crucial nuance. And the slow grower critique we discussed earlier definitely needs this added depth about risk. Blue chips are absolutely not risk-free. That needs to be underlined. They aren't completely immune to broad economic downturns or major global crises. CapTrader specifically reminds us that even during the 2008 financial crisis, very large, very established companies saw their share prices suffer considerable losses alongside the rest of the market.
So stability really means less volatile, not invulnerable. There's a big difference.
Precisely. Less volatile, not immune. Motley Fool's FAQs section notes they can definitely lose value if their sales or profits fail to meet investor expectations. Missing earnings estimates can hit even the biggest stocks hard. Or perhaps more subtly, if their competitive advantages, those economic moats we discussed, begin to weaken over time due to competition or innovation.
A slowly eroding moat.
Yes, and CapTrader's FAQ section is very explicit on this point. They state blue chips can definitely bring losses, especially in difficult times or if the company struggles internally. While diversifying across multiple blue chips helps mitigate the risk of one specific company imploding, it doesn't eliminate the systemic market risk that affects almost all stocks.
Right. You can't diversify away market risk entirely. And you mentioned the risk of overvaluation earlier as well. That seems like a key risk specific to desirable stocks like blue chips.
Yes, CapTrader reinforces this. Their dependence on overall market conditions means that if the market as a whole is generally expensive, blue chips are likely to be expensive too. maybe even more so because of that flight to quality. The risk of overvaluation, meaning the stock prices run up far beyond what the company's underlying financials seem to justify, is significant. Paying too much for a stock, even a fantastic company, can lead to poor future returns simply because the price is more likely to correct downwards eventually, or just stagnate for years.
Buying a high-quality asset doesn't guarantee a good return if the price you pay is just too high to begin with. That's a fundamental investing principle.
Exactly. A high price paid can negate the benefits of a great business. Another set of risks comes from external factors, and these are particularly relevant for the many blue chips that operate globally, as CapTrader points out. Things like geopolitical tensions, trade wars erupting between countries, or unexpected regulatory changes in key markets around the world can significantly impact a multinational company's operations, its supply chains, or its sales in those regions.
Like new tariffs on imported goods impacting a big retailer like Walmart, or maybe new drug pricing laws in the US or Europe affecting a pharmaceutical giant like J&J or Pfizer.
Those are perfect examples of how global events can directly hit a blue chip's bottom line. And CapTrader raises the longer-term risk of fundamental changes in the market landscape itself. Technological innovation or major shifts in consumer behavior can gradually, or sometimes quite rapidly, erode a market position that seemed absolutely unshakable just years before.
The disruption risk.
Exactly. CapTrader uses the classic, almost cautionary tale example of Kodak, a former blue-chip giant that failed to adapt effectively to the rise of digital photography, a technological wave they actually helped invent but couldn't ultimately capitalize on commercially. They were eventually undone by it.
That's such a powerful reminder that even the most dominant companies, the bluest of blue chips from a past era, aren't guaranteed survival if they can't innovate and adapt continuously. Complacency is deadly.
It's a critical long-term risk for any company, no matter how big. And finally, just looping back to that Reddit discussion thread, it brought up some very specific company-level risks that investors are clearly thinking about right now for current blue chips.
What else came up besides the J&J litigation?
Well, beyond J&J's issues, users expressed some uncertainty about leadership transitions at companies like Berkshire Hathaway, wondering what happens once legendary figures like Warren Buffett are no longer at the helm. The current Department of Justice antitrust lawsuit faced by Apple was mentioned, highlighting the significant regulatory challenges that even the biggest, most successful tech companies face.
Right, the anti-monopoly spotlight.
Exactly. And for Google, Alphabet, users cited concerns about perceived stumbles in their AI strategy relative to competitors like Microsoft OpenAI. For Tesla, the focus was on Elon Musk's sometimes erratic behavior and also the signs of slowing growth in the overall electric vehicle market. One user even pointed to concerns about Comcast's significant debt levels and its free cash flow generation.
So it's clear that while blue chip status implies a certain level of quality and safety, you absolutely still need to do your homework on the individual company. You have to ask, are they still innovating effectively? Is the leadership stable and executing well? What specific legal or regulatory headwinds are they facing right now? What's their debt situation look like? That blue chip label isn't a substitute for ongoing analysis, is it?
That's the essential takeaway, I think. Blue chip status is a useful starting point. It's an indicator of potential quality and historical stability, but it absolutely does not remove the need for individual due diligence on the company's current specific risks, opportunities, and valuation.
Okay, this has been incredibly thorough. We've covered the whole spectrum from defining what makes a stock a blue chip, exploring why they're seen as these reliable anchors with their stability, dividends, diversification, and those potential economic moats.
It's a strong pro case.
Right. And then we dove into the counter-arguments about slower growth, the real risk of potential overvaluation, and the various other risks they still face, backing it all up with specific real-world examples like Johnson & Johnson and Procter Gamble. We've also looked at how they fit into a portfolio, potentially alongside growth stocks or access through funds. What are the final concluding thoughts emerging from this whole stack of sources we've examined?
Well, that Reddit thread, I think, offers a really clear snapshot of the diverse opinions investors actually hold about this category, even when looking at the same companies. We saw users arguing that certain blue chips appear undervalued right now, names like Google, Amazon, maybe even Tesla, despite its recent issues. Comcast, Pfizer, Accenture were mentioned by some as potentially good buys based on their own analysis or perceived future prospects.
The bargain hunters.
Exactly. But then others felt some different blue chips were clearly overvalued. Apple came up, PG was mentioned by that analyst, worried about the PE ratio, ExxonMobil, too likely due to their current high valuation metrics relative to their expected future growth forecasts. Some investors on the thread simply favored broad market indexing, like just buying S&P 500 ETF, as a simpler, more diversified way to get blue chip exposure plus everything else.
Just own the market.
Right. And importantly, many users emphasize the absolute necessity of doing your own research, your own homework, and not just blindly taking stock tips from anonymous people on online forums.
Always good advice. So it sounds like there's no single universally agreed upon truth about blue chips as a category, or even about specific stocks within that category. Even among engaged investors looking at similar information, opinions vary widely.
Not at all. There's significant debate. And this really reinforces a key concluding point highlighted by sources like the Motley Fool FAQ and CapTrader. There is simply no one-size-fits-all recommendation when it comes to investing, and that absolutely holds true for blue chips. Your investment decisions must ultimately align with your personal financial goals, your individual tolerance for risk, and your own outlook on the market and the specific companies you're considering.
It really comes down to understanding the tool, what a blue chip is, what it does well, what its limitations are, and then figuring out how it fits into your personal financial toolbox and plan.
Exactly. That's the perfect analogy. CapTrader provides a good summary of their core value proposition. Blue chips generally offer a combination of relative security, potential for continuous, albeit perhaps moderate, growth in income generation through those often reliable dividends. They conclude that blue chips can form a solid foundational basis for many portfolios and are particularly suitable for long-term investors who prioritize lower volatility and asset preservation alongside seeking growth.
Okay, so pulling it all together, the sources suggest they are indeed reliable in many ways. They do offer potential for growth and income, but perhaps not the rapid, explosive growth potential you might find in riskier assets. They are the dependable, enduring players in the market, but you absolutely need to understand their specific strengths, their weaknesses, their current valuation, and the risks they face before committing your capital.
That seems to be the synthesized view from all the material we've explored today. Reliable, yes, but slow growers. Sometimes. Risk-free, definitely not. It's nuanced.
It certainly is. So, as you, our listener, consider your own portfolio and your investment path forward, here's something to ponder based on our discussion today. Given the risks we've highlighted, the potential for slower growth compared to other options, the very real risk of overpaying, the vulnerability to global shifts and disruptive technologies, and those company-specific issues like litigation or leadership changes, are blue chip stocks still the optimal choice for younger investors who have a very long time horizon and whose primary focus might be maximum capital appreciation? Or are they becoming increasingly tailored primarily towards capital preservation and income generation, making them more suitable for those closer to or already in retirement?
That's a great question about generational suitability.
Or maybe looking even bigger picture. In a world that seems to be changing faster than ever, being reshaped by things like AI, massive energy transitions, shifting global supply chains, and evolving consumer preferences, can any company truly maintain a robust economic moat for decades, as some of the historical analysis suggests? Or is the very concept of long-term stability and durable competitive advantage being fundamentally challenged, potentially redefining what blue chip even means for the future of investing?